Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about housing demand and jobs data and how low we could see mortgage rates go if the labor data breaks. First, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. And I'm telling you, I am in Indiana, in Indianapolis, downtown, and it is cold. I lasted like half a second. I tried to go out of the hotel just to touch snow because I rarely get to touch snow. And I just ran my back right inside, got myself a coffee and just said, man, I am not leaving this hotel.
You are not built for the cold, man. You do not do well in the cold. Understandably, you're a Southern California person.
Yes. My high school basketball coach once said, Logan, if there is an ice age, you'll be the first person to die, but you'll have the best looking corpse. So
that's ridiculous. So funny. Oh my gosh. Okay. So it's been a couple of days and we have a lot of data to talk about. So let's start off with purchase apps, which I know is one of your favorite data lines. And also we're seeing some pretty interesting things there.
Yeah. Year-to-date high again. We've had now 17 weeks with mortgage rates under 6.64%. And so we have a positive curve. That means the out of the period in time where we have rates under 6.64 heading towards 6, majority of the data line is positive. Every single week has had positive year-over-year growth. We have more positive week-to-week growth. The last 2 weeks have been best prints of the year because we have positive weeklies and we have harder comps on the year-over-year data, and we still pulled off 17% year-over-year growth with more difficult comps there. So that's the thing that's surprising me, but I need to see positive weekly data, and now we have 11. So hypothetically speaking, let's just assume the next existing home sales report is at 4.17 million. That would mean basically a 270,000 push higher than, I'd say, the lowest monthly sales of the year. We're almost at that 12 weeks. Whenever we get this going to there, we get a couple 100,000 home sales. So just taking the low point of the existing home sales report this year, it could be about 270,000 more. These are monthly, seasonally adjusted. So positive, and this purchase apps look out 30 to 90 days still. So we've had the last 17 weeks have been the best. We're getting better sales data out here. And unlike last year, rates have not shot up. The 10-year yield is lower. The spreads are lower. The curve of the mortgage rate is lower for a longer period of time. That's a positive going into 2026.
That is a positive. And like you said, the fact that we can, we're now in worse comps from this time last year. I mean, it's not easy to beat those numbers. So I think this has been one of the more exciting storylines of the last couple months, which is kind of funny.
We said the housing market shifted mid-June. We always said that our model says 6.64 and under, data gets better. This is the third time this has happened now. I mean, just to give you guys a hypothetical, when we had 5.99% rates in early 2023, that existing home sales print amounted to almost 500,000 home sales on a month-to-month. Now, I think all of the data fell in to that month, and rates had already jumped up higher, so that was going to be old data. But just imagine a little bit lower and staying down here, right? Not going above 7% like we've had to deal with in the last few years. That's a difference. And again, the reason we're here is labor data.
Yeah, I was going to say, we're going to get to mortgage rates here in just a minute for the Fed thing. Let's talk a little bit more about the economic data that we've gotten this week. Jobs, to me, was one of the big things that we got. If you look at the ADP numbers, what did those numbers mean to you?
Okay, so we have a complete divergence in a few of the data lines. The ADP report, negative. The Revlio's monthly data that people have been using until the BLS gets back on par, negative. Challenger, consumer, there's all these other data lines. They're all like not good.
Okay.
But the mother of them all, jobless claims data, initial claims under 200,000. It's really rare in the history of America to get jobless claims under 200,000. But again, those are when the economy breaks and the labor market breaks, jobless claims 323. So the initial claims down, the continuing claims, which means people filing for unemployment rates after 10 days, still elevated 3-year high. So we have a softer labor market, but not breaking. If we were breaking, if jobless claims today were at 291,000, not 191,000, 10-year yield is under 4%. Mortgage rates are lower today.
That's what we need. Okay, so when will we get the next jobs report, the BLS jobs report?
So that's going to come out on the 16th. If everything stands true, again, we just have to get everything back up to speed, and then we could run with the data. But so far, there's enough data out there to keep the same premise: softening labor market, not breaking. Now, there's a view that you don't want to wait until jobless claims break, then go. So this is why it's the interesting discussion is why not be at neutral already, right? And then there's the debate about, these low job numbers are here because population growth is slowing down labor force. Well, we're having negative prints on some of these things. Hiring small business, not great. Manufacturing jobs are still being lost. The especially contractor jobs are being lost. The one positive about lower rates is that the residential construction workers broke there. If it sticks, right? We always get these revisions, and the revisions can change everything. But if it sticks, we got a little bit of bounce back there. So same story, softening but not breaking. But to me, we've always been consistent with this. The labor market needs to break for the Fed, to kind of really pivot to maybe say, okay, we're at neutral, but we like to think about where we're going to do with an accommodative stance. We have never once discussed a federal policy being accommodative. We're just talking about when to get to neutral policy. This is why it's been a slog. And the other news on that is Kevin Hassett is getting a lot of attention this week because of what happened.
Okay, but let me talk about jobs just for another minute, because you've talked about like when we see manufacturing jobs lost, when we see construction jobs lost. What do people make? What do economists make? What does the Fed make when they see those small businesses losing jobs? What does that say to them?
The Fed doesn't care until jobless claims break. They have said this on live TV 3 different times. Jerome Powell's exact words, which it's not going to be the case anymore. Jerome Powell's exact words is, we track jobless claims and they're really low. I think he accidentally said that because it was so nonchalant. But again, I've said we do not want to go into the recession talk until jobless claims go to 323,000. The Federal Reserve themselves wrote a paper about this. They said, well, if jobless claims are at 400,000, that means the labor market's, no, really, McFly? Come on. It's the rate of change. And again, it's never a good thing when manufacturing jobs are being lost and construction jobs are being lost. That's not good. But again, we have a lot of deficit spending. We have the AI boom. We have a lot of construction workers building data centers. So it's a little bit different in this cycle out there. But boy, Sarah, it is going to be so interesting in 2026. Like, I am so happy and geared up for this, because obviously what won this year? Labor over inflation. Because we were told many, 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 many things why rates had to go higher. Inflation, deficit spending, total debt to GDP, treasury supply, my favorite, all these things. And yet we are here near the lows of I think last time I checked, we're 410%. But so it makes it an interesting concept for 2026 that some people could have a bullish economic stance and some people could have a negative economic stance. But then the Federal Reserve comes into play. And let's note, they pushed that BLS jobs reporting to after when the Fed meets, right? And from your perspective, we talked about it, I think yesterday. I was like, do any of these job numbers, does that spur the Fed to do more of a cut? And you were like, no. They did not want to cut it all this year. If it was up to them, getting to neutral, they wanted to get to neutral as slow as possible. We picked up this in late 2022 and early 2023. So they were basically forced to cut because, Jerome Powell came on TV, said the labor market is good. Beth Hammack came on, said it's robust. And then right in front of their faces, you've had some of the most negative forward-looking data in some of the jobs prints. And it it was Team Waller, Team Logan, Team Bowman that kept on early on said labor over inflation. The history of economic cycles, this is not the time to say the job status is great. And we had wasted 1 month this year with that government print that bailed out that one jobs report. If that didn't happen, we would have had this discussion earlier. And here we are. This is just where we're at. We are slowing down. There's sectors of the economy that are getting hit. Remember, not all sectors go into recession, but the ones that are tied to, capital spending and rates and all this stuff are weaker. So it is what it is. It's just that the Fed has flawlessly made my point that they are just going to wait till the very, very last minute. And when jobless claims break, they're going to go, I'm so shocked. I can't believe it. We missed it again, but it just, that data line has not gone negative for them. If it did, if jobless claims were at 291,000 today, 10-year yield is below 4%. And, we're having different discussions, but it's just, that's something they rely on. And there's a lot of data lines, labor data lines that are getting weaker in terms of negative prints, not just slowing down. So they have enough they need to just cut, but I expect them to be super hawkish again as a statement.
Okay, let's talk about Hassett, right? So last time we talked, I feel like three things have happened on him, back and forth, back and forth. What's the latest on, is he going to be the next Fed president?
So we picked up on this, that Trump and a lot of people were mad at Powell after the last Fed meeting, to the point that I even said, you know what, he's probably going to pick Hassett. We talked about that just because I don't think he's going to trust any Fed member. Like Christopher Waller would be a great pick, but he's a Fed person. He needs a yes man. Trump likes loyalty. So there are bond traders that are warding, Trump, investors are telling Trump, hey, we don't like Hassett. We think he's just going to be a yes man. And that's what he is. He's going to be a yes man. So far, the bond market has not done anything. But the second thing we talked about in the last podcast is that I'm looking for Trump to go after other presidents. And later on, the next day, they're talking about making sure that, Fed presidents live in their district, which is targeting hawkish Fed presidents who don't live in their districts, which means, that might be the next thing in 2026 to get enough people out and put his people in to have the votes because he needs the votes. Waller would be better in getting the votes in together and the markets trust him. Hassett, you can just imagine that, working for an institution and this guy is your Fed chair. It's just like, if I have, some of the worst housing price crash doomers and they tell me, okay, this is going to be your co-analyst, this person, so I can't imagine that the Fed presidents are happy that Kevin Hassett now is in the running, but it makes some of their regional presidents targets next year, I believe.
So it's interesting. We talked about this, the fact that they're going after those regional presidents because the focus of the mortgage fraud allegations are like, well, you have more than one house, which is super common if you work in DC, but you have a district, whether you're in Congress or, a lot of people in DC have that dual thing. So it's interesting to me that they've pivoted away from it's mortgage fraud to, well, you have to live in your district.
The Lisa Cook thing, she was a dovish person. So it doesn't really, that never, I just think they're going after people. And remember, this is how the framework works. They're going to make sure they have everything and then, force people out. But this is the tactic of forcing people to live in their districts is a creative one. Out there. So I just imagine if Kevin Hassett is named, that the next thing will be focusing on very, very bearish people. Austin Goolsbee will be number one on the list with Beth Hammock, Lori Logan from the Dallas Fed, Schmidt from Kansas City. I think these people will be targeted by Trump in the next year if Hassett goes in. If Waller's in there, Waller has a better grip on trying to get a little bit more votes because he was correct, right? It was Powell, it was Logan, it was Hammock, it was all these people who said the labor market's robust and great, and we know, and all of a sudden they had to all turn on a dime. out there. So he doesn't get rewarded for that. But it's just, I can't imagine the morale of the Fed is good to think Kevin Hassett, which is better than Kevin Warsh, which again, Kevin, no, both the Kevins not good. But in this case, this is the world we live in. We just have to model it out and try to make sense of it.
Okay, so let's talk about that. How low could mortgage rates go given you get Hassett in there or whoever Trump picks that and then he starts going after different Fed presidents? Like how low can it actually go?
I still don't believe they can really move the needle too much because the market, to me, Trump, Kevin Hassett, Waller, the labor data is more important. Because if jobless claims were breaking, it didn't matter if Powell said, I wanted to hike rates. The market will dictate to them. So a hypothetical, let's just say the economy outperforms next year. And inflation is a little bit more firmer because the people are spending. And can the 10-year yield really go much lower if the labor data gets better? I mean, my whole thing is labor or inflation. So I think that becomes more of an interesting discussion because so much of the rate cuts are already priced into the 10-year yield and mortgage rates. It's really hard for me to forecast below 5.75 with neutral policy. That's why I have that level there for the last 2 years. But it makes the ARM loans look better, and they're already picking up. We're even seeing the builders start to incorporate ARM loans as part of their business model for 2026. But there's going to be so much interesting things, but above all else, above Trump, Powell, Hassett, Waller, the whole Fed, the labor data runs the show.
Okay, well, what if the labor market what if the labor data breaks? What are we looking at there?
If the labor data breaks, you can get to neutral policy to talk about accommodative, and that's how you have mortgage rates with a 5 handle. That would be easy. And then spreads could get a little bit better too. I mean, if spreads were back to normal, we're already 5.65, 5.75 already in that. Spreads should get almost back to normal next year, and you can have 5 handles. Why do we always talk about the 5 handles? Because for some reason, housing data gets better. And I was speaking at an event this morning. I'm going to speak at another one in about 30 minutes, and I tell people, listen, the builders are at 2019 home sales levels. What do you think? They're better salespeople? No, they are offering lower rates. That's like 1 million to 1.2 million existing home sales. So they are efficient sellers. They have profit margins. Not all the builders have that kind of, but they can move product. And the existing home sales is still down here. Right, demand gets better when rates get down towards 6%, but they're like 4.5 to 5.875. Just hypothetically speaking, with all the data that we have known now for the last 2 years, what if mortgage rates are at 5% for 12 months?
Oh my gosh!
Everyone is doing more business.
Absolutely,
but that can't happen in the existing home sales market. That's not an efficient a seller's market like the builders. I always say the builders are efficient sellers. They're not the margin dimes. And they sell homes like a commodity because they got to sell it. And then the next one's got to come in and they got to build. So that's different than buyers and sellers and how much sellers need to sell their house. Well, there's all these variables that here is just got to make enough money to make a profit and then move on out there. So it does get interesting because the ARM loans are going to be sub 6% for 2026, unless the economy really recovers and the labor data gets really better. And then the whole labor inflation model turns up to where yields can go up. But because we have so many rate cuts into the system, we can stay in the lower end range easier than 2023 and 2024. Remember, 2023, we were still hiking rates. All we talked about is back then, we're done hiking rates. 2024, begrudgingly cutting rates. They waited all the way to like September until the labor data really got better. And Jerome Powell himself said it. We were a little bit late in cutting rates in 2024. This is just how they operate. So,
yeah.
It's going to be so much fun, Sarah. It's going to be so much fun. That backdrop is going to be you really have to be on the economic game to talk about everything in 2026 because it's not so cut and dry easy.
Which is why people should come to the Housing Economics Summit. You're going to be headlining Barry Habib, Mike Simonson, Jessica Lautz, Odetta Cushy. We have so many great economists coming. It's going to be in February 10th, which gives us enough time to see what's happening in the year and plan for the rest of the year. I'm super excited about that.
And on that note, the first time homebuyer median age. Okay, so this came up in the discussion today, and if the first time homebuyer is 40, then they might be dead by the time they pay off their house. However, the reason I discounted that, and I try to explain this, if you take the New York Fed and the AES, which is the government data on this, even Zillow, their median age buyers is like low 30s, mid 30s, and it's pretty much been stable in this. The NAR has deviated from everything, and their surveys, percentages, responses are questionable. So the reason I didn't like that survey is that the NAR surveys for first-time homebuyer percentage was 21%, except their monthly sales reports each month is around 30. So that survey is not doing good. There's such a divergence that I think there is almost like a unanimous, like once people realize what the data looks like, that survey is not getting any credibility right now. And when we have multiple data line sets from other sources saying one thing and one breaks out and it's a survey with a very low percentage, and my concern is that if mortgage rates went lower, more first-time homebuyers came in and more surveys, that age could drop, and that would be incorrect as well. So I think that survey's created a little bit more confusion than given answers.
Well, we will get all the answers in between here and there, but also at the Housing Economic Summit, right?
Yes, boy. When you have so many economists,
I'm trying to set you up for this.
No, when you have multiple economists and analysts in one area for one day, that is rare. That does not happen. Usually you have an event where there's one economist or one analyst speaking, but when you have multiple people with multiple different views, you get to see the total picture out there. So you could take whatever you want from it, but when charts and data and models collide, it could be interesting out there. And I think that's why I love that event more than any others. It's just because I've got all the nerdy people in, and I got people that I know are working with data and charts and not just throwing stuff up in the air and trying to get attention. So I think that's going to be the most useful, because by the time February comes, we'll have enough data to kind of see where spring is going out there.
It's going to be amazing. Logan, thank you so much for being on. We'll talk again soon.
Pleasure.